know me, I am a director in our state and local tax group at Eide Bailey, and I physically sit in the Denver office, and I'm going to go ahead and turn it over to Mary Jo to introduce herself.
Good morning. My name is Mary Jo Zulsdorf. I'm a manager in our state and local tax team, and I also sit in Denver.
So we'd like to welcome everybody today to our presentation on Colorado sales tax basics and reform, but we're going to take a step back first and talk a little bit about NEXUS, historical background on NEXUS, so that it sets the stage for what we're going to talk about with respect to Colorado and some of the changes that have occurred in our state. First and foremost, in order for a state to tax a taxpayer, there must be some kind of link, and that link is defined as NEXUS. And so NEXUS is a determining factor in how a state can tax a taxpayer. And there's lots of different NEXUS triggering activities that a taxpayer can be engaged in, and those have been kind of decided over the past many years of precedential case law. And probably for some of you on this call, on this webinar, Quill probably sounds very familiar because of kind of the climate that we're in right now with the changing landscape of sales tax NEXUS. But there's other cases before that. Obviously, this has been an evolving area for many years. And fast forward to 1992 when Quill was decided, which was originally a North Dakota case. And what Quill stood for was that the U.S. Supreme Court decided that a taxpayer must have some kind of physical presence in a jurisdiction in order for NEXUS to be triggered for sales tax collection purposes. Now, interestingly enough, in the lower courts, Quill had actually lost, and North Dakota had determined that taxpayers may only need to have a economic presence in the state. And so I think for those of you that are familiar with where we are right now in the wake of Wayfair, which we're going to talk more about, I think that Quill kind of just was a little bit of a foreshadowing, at least at the lower levels, to where we are today. But suffice to say, with Quill, physical presence was the lay of the land and the standard for many years. And then as time has gone on, and we had the Direct Marketing Association case, which is something that for those of you that are in Colorado, you may be more familiar with. But the Direct Marketing Association was basically a group of marketing retailers that came together that challenged Colorado's rule that was put in place in 2012 that indicated an out-of-state retailer that was not charging sales tax or did not have to charge sales tax in Colorado had a notice and reporting requirement. And so that rule was put in place in Colorado, and at that time was a rule that was pretty unique, and then it was challenged in DMA, and ultimately, in a unanimous decision, it was decided that that actually was not unconstitutional. And at the same time, Justice Kennedy indicated that really this was a situation, we were in a time with remote sellers and sellers selling online, et cetera, that we really should be reexamining Quill and Bellis Hess and the whole physical standard or physical presence standard for NEXUS. So then the states were taking a look at this, obviously, and in comes South Dakota saying, okay, you know what? We know that we've got all these remote sellers doing business in our state. They may have headquarters, they may be, only having a physical presence and shipping from outside of our state, but we know that they're shipping into South Dakota, so therefore we're going to take an economic NEXUS standard, put it into our law, and see what happens. And so what South Dakota did in 2016 was they put in a bill, and it was ultimately passed, saying that if a taxpayer, remote seller, had NEXUS because they could have had annual in-state gross revenues exceeding $100,000, or if that remote seller had 200 or more separate transactions in the state. So that was on their books and ultimately was challenged in Wayfair. And so many of you on this call probably have heard a lot about Wayfair, may actually be, trying to grapple with some of it or have some procedures in place already, which is great. But, as most of you are aware, this is completely changes the landscape for sales tax NEXUS, and was decided on June 21st of last year. Key takeaway, obviously, saying that all you have to do is make sales into a jurisdiction over a certain threshold and not have to have physical presence in that jurisdiction. Now, keep in mind that physical presence is still a NEXUS trigger. So those taxpayers out there that, for example, might be selling on Amazon, for those of you that know how Amazon works or may actually be part of the FBA program, there's inventory that will be sitting in an Amazon warehouse and could be sitting in multiple warehouses and also could be moved around. So at Amazon will be the one moving it. So that's physical presence. So having that inventory sitting in a jurisdiction, that's physical presence, and so you don't have to worry about Wayfair in that case, right? Because at that point you already have physical presence, and you would need to register and collect on your taxable sales in those jurisdictions and file. However, if you are a pure remote seller, and remote seller means a lot of different things, if you're a pure remote seller, then you need to look and see whether you exceed these thresholds, and we'll talk in a few slides about how other states are reacting. But as you know, many of you on the call, a lot of states have started to put in rules of their own that are similar in the wake of Wayfair. So what came out of Wayfair? What was the ultimate decision here? So this was, again, decided June 21st of last year. It was a 5-4 decision in favor of South Dakota's rules. Again, the physical presence standard was overruled, and the court said that it was unsound and incorrect, even when decided in 1992, which is kind of interesting. And again, might go back to what I mentioned earlier about at the lower courts during Quill, the state of North Dakota said, well, we don't care. Quill had an economic presence in our state. So again, some foreshadowing there, but fast forward to 2018 and the court saying that Quill's decision was unsound and incorrect. The appropriate test is whether the taxpayer avails itself of the substantial privilege of carrying on business in the jurisdiction. And the dissent suggests that while Quill may have been wrong, Congress should be making changes. So with that, we're going to go to our first polling question. True or false? The court overrules Quill's physical presence test, saying it was unsound and incorrect, even when decided in 1992. All right, true. That is correct. All right, so now we're going to talk about how other states are responding. And bear in mind, I know this is Colorado presentation, so we've got a good portion of Colorado on here, but again, we wanted to make sure that everybody understood kind of the background here, and then how we'll launch in more on how Colorado is responding later. But suffice to say, we've got a lot of states in the wake of Wayfair, and they have come on board at various times, had various enforcement dates, but a lot of states fall into this first category of following the rules that South Dakota had in place. So that would mean states with similar thresholds of having to have greater than $100,000 of sales into the jurisdiction or 200 transactions. Generally speaking, that $100,000 number is met on gross sales. There are some nuances with some of the states on that. However, generally speaking, it's gross sales. So you may have a situation where a taxpayer is a wholesaler. Well, even still, if it's $100,000 of wholesale sales in a jurisdiction, the jurisdiction would say you've met their NEXUS standard. Then there's states that have different thresholds. We've got a few that have different thresholds, at least right now. We've got Georgia that's looking at changing their standard. I think right now they have a $250,000 threshold, and they have a bill right now in the legislature to lower it to 100,000. Idaho has a completely different rule that is not necessarily in line with the $100,000 or 200 transaction. However, they may look to change that as well. There's a couple states on here that have what we consider and, so it would be a certain dollar threshold and number of transactions that must be met, so a little bit more stringent test. And then there's also states with marketplace facilitator rules, which basically means that like an Amazon, for example, is considered a marketplace facilitator. And what these states have done is they have generally, most of the states have expanded their definition of who's a retailer to include a marketplace facilitator. And so marketplace facilitators then would need to register and collect tax on behalf of their the taxpayers that they sell for. So there's that list of states that have those rules is getting larger as time is going on. So again, for those of you who may be familiar with, fulfillment by Amazon, and if you're part of that program, you may already be aware of some of the states that Amazon is collecting on your behalf and remitting. So those are how Amazon is doing that because of the marketplace facilitator rules, partly at least. So look to see on this list, not everybody's on here, obviously. We don't see Texas, although our understanding is that they potentially will be coming online with a rule later this year. Oklahoma also will be, or at least has a bill in place or in the legislature right now to put in thresholds. And Kansas is also coming on board potentially soon. And you may notice that not every state's on here, but we have several states that have addressed it in some way, shape, or form. Again, not all cookie cutter. We've got Florida that's not on here yet. We've got Arizona that's not on here yet. There's a few that haven't passed legislation, but as you can see, that this list is fairly long, and so we've got most states that have passed some kind of legislation in response. So while we have states that have passed the economic nexus thresholds, meaning that if a taxpayer exceeds those thresholds, they have nexus and they have a duty to register and then collect and remit to the states. Now, I mentioned earlier about the Direct Marketing Association case, which was in response to Colorado's use tax notice and reporting requirements, which actually are still there, and there's several states that are on the slide that also have similar rules. Now you'll notice that some of these also have economic nexus rules. So we've got situations like Washington where they have notice and reporting, but they also pass economic nexus. So once you exceed those thresholds for economic nexus, then you would not have the responsibility for notice and reporting. However, we have a few states that, like Pennsylvania, that still only has notice and reporting. And so what this notice and reporting requires is that a taxpayer must notify their customers if they are not registered to collect in the jurisdiction in which they ship. So, for example, Pennsylvania. So if we have a taxpayer who's shipping to a customer in Pennsylvania, they have a duty to notify their customers in Pennsylvania that they are not collecting, that the taxpayers and their customers in Pennsylvania may have to self-assess use tax. Then the reporting side of it is to send some kind of documentation, and the states that have these rules all have their own requirements as to what needs to be submitted to the actual states, with a list of the customers and their transactions perhaps that were made through the course of the year into their state, so that the department has a record of the customers in their states that purchased items, quote unquote, tax-free. So Colorado had this notice and reporting rule come into place effective July 1st, 2017. Again, transactional notice to customer at time of sale, and then the annual purchase summary that I was referring to is due by the end of January. So for 2018, that was due January 31st of this year. There are states, Colorado is one of them, that has some penalties associated with not complying. Some states don't have as steep of penalties as others. And Washington, for example, has steeper penalties than even Colorado. But suffice to say that our out-of-state taxpayers that are not complying with these rules could potentially get hit with some penalties for failure to send the notices, failure to send the annual purchase summaries, etc. I'm going to go to our second polling question. What is the effective date for the Colorado's use tax notice and reporting requirement? July 4th of 2017, July 1st of 2017, September 15th of 17, or none of the above? All right, it looks like most everybody got that right. It's July 1st of 2017. And so before I pass it over to Mary Jo to go through more specifically on Colorado, I want to just make some comments on just kind of generally with the states and these requirements in the wake of Wayfair, because I think we've gotten a lot of taxpayers, and rightly so, concerned or stressed out a little bit about the fact that, okay, we may have NEXUS in a lot of jurisdictions, and that might be true. However, also what I want everybody to keep in mind is that while you may have NEXUS, or these, our taxpayers may have NEXUS, we still also have to keep in mind that the taxability of the transactions still need to be considered. So don't forget that, even though you have NEXUS, perhaps you're 100% wholesaler, or perhaps you're selling an exempt item, things like that. So yes, Wayfair stands for NEXUS. However, the taxability still matters. And so don't forget that. And then also, I just want to make a comment related to state income taxes, because as you can imagine, we've got clients that are going out there and they're registering, they're doing the right thing from a sales tax perspective. And we're seeing some states then sending inquiries and or NEXUS questionnaires saying, okay, well, you're registered for sales tax purposes, where's your income tax return? So they don't always necessarily have to go hand in hand, of course, because perhaps your income may not necessarily be taxed in a jurisdiction for income tax purposes, and that's because of Public Law 86272. And so I caution everybody on here just to know that we are in a little bit of uncharted territory, because we've got lots of taxpayers going out there, they're registering, and it could be triggering inquiries from states on other types of taxes. However, like I said, if you're selling a taxable good and the only activity that you're doing in a jurisdiction is the solicitation of that taxable good, then you potentially have Public Law 86272 protection for income tax purposes and may not have to source the income or have a tax liability in that jurisdiction. So just a couple things to keep in mind as you're navigating Wayfair and taking a look at your sales volume and whether you should be registering, and if you are registering, and things of that nature. But with that, I'm going to go ahead and turn it over to Mary Jo, and she's going to talk more about Colorado in particular.
Okay, so we've talked about how all the other states have adopted new laws or regulations to adopt an economic nexus standard. Now we'll talk about specifically what Colorado is doing. Oops, sorry, went too far. So as we already previously mentioned on an earlier slide, Colorado adopted the exact same standard as South Dakota of $100,000 of sales or 200 separate sales transactions. This law in Colorado became effective December 1st, 2019. However, the state has issued a grace period to allow vendors to comply that extends through May 31st, 2019. It's possible that this may be extended farther. They've provided a grace period to allow the legislature to decide on this regulation because it was just issued through a regulation, in addition to a new sourcing regulation that we'll talk about here in a moment. Another thing that's very important to note about the new economic nexus standards in Colorado is that if a company chooses to take advantage of this grace period through May 31st, which I don't know why you wouldn't, but If you choose not to, you are still subject to the notice and reporting requirements. So if you have over $100,000 of sales and you are not physically located in Colorado, as of right now, you basically have the option of either complying with the notice and reporting requirements, kind of tattletaling on your customers to the Department of Revenue that they owe use tax, or instead voluntarily becoming registered to collect the tax. So I think that that's often overlooked because these notice reporting requirements have kind of lost traction as the states have started coming out with these new economic nexus standards. So some things about, some concerns that we have about Colorado's new economic nexus standard. I'd like to kind of talk about these for a few moments, because in the Supreme Court's decision in the Wayfair case, there were a few factors that the court commented on about South Dakota's law favorably, and these things are all things that Colorado doesn't have. So we're kind of sitting back to see how everything rolls out here in Colorado. The few things that the court commented favorably about were, one, that it provided a safe harbor threshold for small businesses, so that businesses who had less than $100,000 or 200 transactions would not be impacted by this. Also, that they were not going to apply the law retroactively, and that the state provided simplification through streamlined sales tax. So South Dakota has one single state level tax rate. They have uniform definitions of products and services, and free software for filing the returns. That software it's a little misleading. That software doesn't do rate checks and things like that, but they provide a software that you can file your return online, and they provide audit immunity from errors in the software for the filing software. So those were things that the court kind of commented on favorably. Now, look at what Colorado has here is quite the opposite. We do not have a single sales tax rate. In fact, we have over 600 different combinations of combined tax rates in the state. So for those of you who aren't familiar with Colorado's sales tax landscape, we have what's called statutory cities and home rule cities, which differs from most states. There are a few other states who have a similar scheme, but Colorado has 71 home rule cities, and those home rule cities administer and collect their own sales taxes. So they have their own sales tax code, they have their own tax return, you have to get your own tax registration, they have their own audit departments, and the tax base differs from city to city, and it differs between the cities and the state. So it's pretty complex. So I think that it's very clear that Colorado doesn't have a simplified sales tax system as South Dakota did. We do here in Colorado have a website for online filing. However, not all of the home rule cities do have that yet. I think that they're all trying to get on board with that, but it's a process. And it's, the way it is currently, all of the cities have their own websites that you have to file separately from the state. So you can't just go to one website or one portal and remit all of your taxes. You could potentially have to go to 72 different websites to file all of your different Colorado city and state sales tax returns. So that sounds fun. And then in terms of the audit immunity, what Colorado does have is a hold harmless clause in their statutes that essentially says that if you as a taxpayer rely on one of the databases that the State Department of Revenue has certified, if you rely on the rates provided by those databases and they happen to be wrong, that they will hold you harmless and not impose any additional taxes in an audit situation. So right now, I think that there are 5 state certified databases, and they have varying different degrees of services that they provide. Some of them are just a rate check. Some of them have filing capabilities. Some of them don't. We'll talk about that a little bit more. But the key takeaway from this is while all these states are going out and adopting these exact same, including Colorado, adopting these exact same thresholds as South Dakota that the U.S. Supreme Court has already ruled upon, not all the states have the same tax structure as South Dakota. So it will be interesting to see whether or not some of these get challenged, and particularly here in Colorado where we have a far more complex system. So in addition to the state's new economic nexus standard that provides that out-of-state vendors may have to collect and remit their sales tax, the department has also recently issued new sourcing regulations. In September of 2018, the Colorado Department of Revenue sent out notices to all registered taxpayers that said that beginning December 1st of 18, taxable sales are now destination based. So you would have to collect the sales tax based off of the location where an item is delivered. And so most of you are probably out there thinking, so what, big deal, that's how it's done in almost every state, in most destination-based states. And that's true, but most states don't have so many different combinations of sales taxes like we do here in Colorado. So this is actually a pretty big deal, and it's a pretty big departure from how it was previously done in Colorado. Previously and currently, because of the grace period through May, the way that we source sales in Colorado is kind of a hybrid of a origin and a destination. A retailer located in Colorado collects the sales tax rates for the jurisdiction where it is physically located, and when it delivers an item to somebody outside of those jurisdictions, it only has to collect the jurisdictions for which it shares with the customer. So as an example, you may have a customer that is located in the state of Colorado in Jefferson County, and they are within an RTD, a regional transportation district, special district, that are state collected, and they deliver then to somebody in Arapahoe County that's also in the regional transportation district. Well, they don't have to collect the Arapahoe County tax because they don't share that jurisdiction. But under the new laws, they now will. So that is what is changing here. It's quite a big change, and it's quite confusing. So this came out via an emergency regulation, and there are still some things that we're a little unclear about or that we have concerns about as it relates to this sourcing rule. One is that they haven't really defined possession very clearly. It's taxed based off of the location where the customer takes possession, and there's some inconsistencies about when a item is picked up at the dock by a customer's third-party delivery service. So that we're hoping they will provide some clarification before the regulations are finalized. You'll see here in the slides, there is this kind of a landmark case here in Colorado involving home rule city taxes that says just that if a vendor has a third-party carrier pick up items on its behalf at the dock of the seller, that is the point of delivery where title and possession transfer. And this new regulation seems to say the exact opposite. So we are hoping that those will align, because we don't want any more inconsistencies than we already have between the state and the home rule city taxes. Another concern here for those of you who have been in the Colorado Revenue Online system to file sales tax returns, you know that there is a branch ID associated with every combination of taxes, essentially. And so it just makes it quite complicated to report taxes for various different jurisdictions, because you can't just drop down and report all of your Jefferson County tax in one bucket. You may have several different branch IDs that you need to file for that will have Jefferson County, but a different combination, could be within a different city or what have you. So our current system is rather complicated. They have made some new changes to the system to simplify it, but it's still probably not conducive to reporting all of these different jurisdictions. And each of those branch IDs, you have to file a zero return if there's no tax owed, so it's just going to be rather time consuming. I can't stress this enough. It's complicated because we have so many different combinations of taxing districts. We have overlapping cities, counties, special districts, and some of the cities are state collected, some of them are home rule. It's complicated even for those of us who live here and understand the system quite well. For those out-of-state vendors, I hardly think it's even possible to figure out all the different home rules and state collected without a pretty sophisticated software system. And as we know, those can be rather pricey and not always that accurate here. We have another kind of quirk in Colorado where our zip codes don't necessarily align with city boundaries as they do in many other locations. And so it's really important to have a good software here. And some other concerns is that even with this grace period through May 31st, given the magnitude of this change, it just may not provide taxpayers and vendors with enough time to get their systems in place. And there's been a little bit of outcry from the non-for-profit sellers because they will now be required to comply with this also. And just given how complicated it is really going to take away a lot of time and resources from their charitable purpose. This next one is kind of interesting. So some of the much smaller businesses in Colorado feel as if they are burdened with more tax than out-of-state vendors because they don't receive that small business benefit of not having to comply if they're under the $100,000 or 200 transactions. There was just a bill that was proposed that I believe it's kind of at a stopping point for at this point. I don't think that it's moving forward any farther, but that was going to allow an exception for this, which would have probably just made things far more complicated. But anyway, that is kind of an interesting point, is that our in-state vendors have to deal with this while the out-of-state vendors maybe don't. And in most cases, we like to provide a little bit more simplification for our in-state vendors. And then just going back to what we had already discussed, is that the state certified databases have various different levels of service. And so while you may want to do the right thing and protect yourself and rely on one of these state certified databases, some of them don't provide all of the functions that are necessarily needed to fully comply with the sales tax laws. So they may only have a rate verification, but they might not have any other capabilities to tie in with your accounting system for reporting purposes or tax return preparation. And then in addition to that, these databases are certified by the State Department of Revenue, so meaning that that protection extends to state of Colorado taxes and other taxes that are collected by the state of Colorado, which includes all counties and special districts and some cities, but it doesn't necessarily extend to the home rule cities. There are currently 10 cities that have adopted similar provisions in their ordinances to rely upon these state certified databases, but only 10 out of 71. Down here at the bottom, you can see a list of all of the cities that do have hold harmless ordinances in their cities. Fortunately, it's some of our larger metro area cities. You see Denver, Boulder, but there are many that do not comply. All right, so with that, I'm gonna show just the current certified databases that the state of Colorado has. These are on the Colorado Department of Revenue website. And you can see some of these have a free lookup tool. So that's a really nice if you just need to look up one address or a few addresses, but beware that most of these have a limit to how many that you can look up for free. And then if you're going to need the service for more than 10 transactions or a certain number of transactions in a month, you actually have to subscribe and pay a monthly subscription fee. But these are out there, so if you're ever selling somewhere in Colorado and you need to verify the appropriate rate, I recommend these. I use these quite often myself. It's not always clear with the inconsistencies with the zip codes. All right, so we'll move on to polling question number 3. True or false? Zip code boundaries do not correlate with city or county boundaries. Okay, yep, that's true. So our zip code boundaries do not always correlate with the boundary. All right. So how do the home rule cities vary? This is where it gets really fun and interesting here in Colorado. So as we previously kind of touched on, all of these different home rule jurisdictions, some of them piggyback off of the state and they have the same rules, even though they have their own city ordinances. They follow the state statutes. However, many of them have their own tax bases, their own imposition of tax and exemptions and exemption forms, etc. So it gets rather complicated. We'd like to just show an example of how the taxability of an item may differ between the state of Colorado and a home rule jurisdiction. And we'll use kind of software as an example because this comes up a lot. So the state of Colorado defines tangible personal property to include computer software that is prepackaged for repeated sale or license, is governed by a tear open, non-negotiable agreement, and is delivered to the customer in a tangible medium. So basically, the state of Colorado only imposes sales tax on software that is delivered in a tangible format. So software as a service licenses, software that's maybe downloaded electronically onto your servers, those kinds of items are not subject to Colorado state tax or taxes that are collected by the state of Colorado, which differs from the city of Denver. The city of Denver, not only does it impose tax on tangible personal property, but it also imposes tax on the purchase price of digital products, software programs, software as a service, software license fees, and software maintenance agreements. So it's pretty all-encompassing, and that's the exact language from the imposition statute of the Denver Revised Municipal Code. So you can see they've really gone out and roped in all of those products that are often kind of hard to identify in other state statutes. And they have even gone so far as to define all of these items. I will caution that these definitions are relatively new. The city just, along with many of the other home rule cities, recently adopted some new standardized definitions. And so most of these definitions didn't exist up until about a year ago. And at that same time, Denver changed this imposition statute. But even prior to that, they imposed tax. Their imposition ordinance said that they imposed tax on data processing systems and programs. So it was more vague, but I think it encompassed all of these items that they have separately identified here. So you can see down there kind of the definition of a software program, and it includes canned software, modified software, and customized software. So basically, if you are purchasing any software in Denver, it's subject to the city tax, but it's only subject to the state tax if it's tangible. And then here are some more of the other definitions that they have noted in their imposition statute: software as a service, license fee, maintenance agreement. So I think that that's a key takeaway here. And another thing that I'd like to point out that we haven't really spoken about yet when it comes to home rules and the difference in these new sourcing regulations is that under these new sourcing regulations, where a vendor is now required to collect all statutory or state collected taxes based off of the delivery location, as of right now, that only applies to state collected jurisdictions. So if you, as a vendor, only have physical presence in one jurisdiction, one home rule jurisdiction in Colorado, say you're located in Denver, Colorado, and you are delivering items into Aurora, Colorado, you would have to collect all of the state collected jurisdictions on that sale, which would be the state of Colorado, your regional transportation district, cultural districts, and the county, Arapahoe County probably, but you would not necessarily have to collect Aurora city tax. The home rule cities are still relying on a traditional physical presence nexus standard for now. I guess we just kind of need to keep our eyes to the sky and see what happens next. I imagine at some point they will adopt some kind of an economic nexus provision, just like all of the other states. And we're seeing some other local jurisdictions in other states adopt. But for the time being, you have to actually have a physical presence in a home rule jurisdiction to have a filing obligation. Now, keep in mind that a physical presence doesn't necessarily mean a brick and mortar location. Going back to kind of what Stacy had spoken to before, these taxing jurisdictions take a pretty aggressive approach as to what constitutes a physical presence. You know, travel, delivery in company-owned vehicles. We have some states who have what's called a cookie nexus, where if you link cookies onto somebody's computer when they're visiting your website, they now say you have physical presence in a state. I haven't heard that argument from Colorado's home rule cities yet, but just wanted to give you a flavor for all the different kinds of ways that could create physical presence, and know that the home rule cities still rely upon on that traditional physical presence standard. So we'll go to our last and final polling question, number 4, and then we'll talk about the questions that we've been getting through the website. So true or false, Colorado Revised Statute 3926-2041A imposes tax on sales and purchases of tangible personal property at retail.
You want to go ahead and move on to the questions there, Mary Jo and Stacy?
Yes.
Okay, so let's start with question number 1. Are the tax notice and reporting requirements required if the sales tax registration and collection are already occurring?
So I can take this. No, they don't. So if you're already collecting sales tax, you don't have to comply with reporting requirement. Some states, like Washington, for example, if you have sales within a certain range, you have an option to either register or do notice and reporting. But generally speaking, once you've made an election or met a requirement to collect sales tax, you no longer have to comply with the notice and reporting requirements.
The next one, does the use tax required fall under the 100,000 limit or the 200 transactions?
It does not. So use tax is imposed on the use or consumption of an item, regardless of how much you use or consume in a state. So you're always going to be remitting that tax probably to the jurisdiction where you're located and you're consuming those items.
All right. Is food a taxable good?
I would say yes. Well, in terms of, I don't know when this question came in, if this is related to the Public Law 86272, the tangible goods, it would be tangible. Whether or not it'd be taxable, that varies by state. Most states provide an exemption for food for domestic home consumption. However, there are a few states and local jurisdictions that do impose sales tax on food products. Most states almost always impose tax on prepared food, like if you go to a restaurant or a deli, but often provide an exemption for groceries.
Okay. Are there any implications for Colorado nonprofit organizations that hold sales tax exemption certificates?
Well, they are still not subject to use tax if they hold an exemption certificate. However, they may have to collect sales tax if they're making taxable sales of tangible items. There are more rules around that, some limitations. You have to have sales over a certain amount before you are required to start collecting, but I would consult with your tax advisor on that if you are a non-for-profit in Colorado making sales that could potentially be subject to tax.
Okay. If the ruling is in favor of title passes when it leaves your business because it's picked up by a third party, wouldn't that solve the problem? Or would you be charged the rate at the facility?
Yeah, I guess we'll have to see what happens when they issue the final regulation. So currently it is based off of the delivery location, but they have this, and that includes in the emergency regulation when you have a third party carrier pick up at your dock that's seller arranged. But I would suspect that that will change before the final regulation is issued. And in fact, the Department of Revenue recently came out with a pretty lengthy new tax guide that indicates otherwise, that if a seller arranged for third party pickup at the dock, that would be the point of taxation. So yeah, that could be an option. I guess we'll have to just see how that shakes out. From a business standpoint, I don't know if that's always going to be practical, but so to answer your question, I think that maybe that might help solve some of your pains with that sourcing issue.
All right, we have two more. Can you comment on what is currently happening at the state legislature regarding one-stop filing software for state, statutory, and home rule can't talk. Sorry, you want to say that word?
Municipalities.
Yes.
Too many vowels.
Yes.
Yes, so there is a bill out there right now that was created by the Sales Tax Simplification Force. And what they are trying to accomplish is to procure a software program that would provide for basically a one-stop shop for all state and home rule jurisdiction taxes. So you would be able to go to this one place and register for all of the jurisdictions. They would have standardized forms. You would be able to file all of your returns from that location. They would also, the goal is to have a matrix that indicates the taxability of various different items from all of the different jurisdictions, and some other things like that. So that is on the agenda, and that is there is a bill. They last year already had a request for information, and they received a few different responses. I believe 4 responses to that, and now they're moving forward with that with a request for proposal. And so ideally, the Department of Revenue will have something like that out there in the near future, but near future in government terms, I don't know exactly how soon that will be.
All right, the last one that has come in says, this may not be part of the seminar, but if we as businesses receive notice from out-of-state retailers with purchases we made that did not have sales tax, what are we required to do as a business?
So those are those kind of nasty grams that come from the notice and reporting requirements that we spoke about at the end of the year. By January 31st, out-of-state vendors have to send the Colorado customers a statement of all the items that they've purchased, indicating that they may be subject to use tax. So I know we've had many clients receive these and asking just that same question, what do I do with this? That means that you should probably review those items and determine whether or not tax is owed. So if it was an item that was used or consumed by your business and not sold in the regular course of business, resold, then it's likely that you will be required to accrue and remit a use tax on that. And so you would have to just report that tax directly to the state of Colorado and potentially to any home rule cities if that applies. one thing that's kind of interesting, I guess, about Colorado use tax, it's often overlooked anyway, is that the use tax actually goes on a separate form than the sales tax. Consumer's use tax in Colorado is reported on DR 0252. And so if you get one of those notices and you review it and determine you do owe use tax, then you should report that on DR 0252. And you can also do that through your revenue online account if you're an online filer. So I think is that all of the questions we have today?
One more just came in, so let's answer this one real quick and then we can move on. How would a business handle sales tax if they had a one-time job for another area?
So if you have an occasional sale, there's an occasional sales tax form that you can report on. So you may not necessarily need to file recurring returns month after month or quarterly. There's what's called an occasional sales tax form.
And Mary Jo, there's some of those for the home rules too, right?
There are. Yep.
Yep.
You might have to contact the home rules directly. They might not have it on their websites because they don't always have as much information available, but most of the time they have some way for you, some mechanism for you to report just a one-off tax remittance.
Excellent. If you guys have any further questions, please feel free to reach out to us directly and we can get those answered for you. Other than that, there's no other questions that have come through. So Stacy and Mary Jo, if you're good, we can move on.
Yeah, thanks everybody for attending.
Yeah, thanks everybody for your time, and feel free to reach out to us if you have any additional questions.
Awesome. Thank you all so much. Have a great day.
Thanks.
Bye.